Hey, good morning. Happy Sunday, everybody. It's probably Monday as you guys are viewing this in cold and damp Chicago area today. With me is Chris Sorensen, our Executive Vice President of Finance. My name is Mark Porter, CEO of Highwire Networks. We're here to break down our earnings release from this past Friday and share some of our thoughts on where the company is and what the future looks like. So with that, I'll turn it over to Chris for a brief recap of the results, and then we'll talk a little bit about some of the high points and some of the discussion analysis, and hopefully answer some of the questions that our investor base may have. Chris?
All right, thank you, Mark. Just to start off, for comparison purposes, we have some figures that we're comparing actual to pro forma and pro forma. Reason for that is with the recent merger acquisition, we wanted to make sure that we've got numbers that are comparable when you're looking at year over year and quarter over quarter. So to start off, actuals for Q3, revenue came in at $11.37 million. Compare that to a year ago pro forma of $8.4 million. So we saw a nice growth year over year of about 35% on Q3. Year to date through Q3, we have a pro forma of $31.33 million. And you can compare that to 2020 year-to-date Q3 of $27.09 million. So again, another nice growth year over year on a year-to-date basis of 16%. So, just to kind of give you an idea, what we've done over the last 2 to 3 quarters in integrating the businesses together, we've really set our cost structure up to a good platform as we look forward at future organic growth. That includes integrating the sales teams and really getting our corporate SG&A to a spot that we can facilitate that growth and support it without a large incremental cost structure going
Thanks, Chris. As Chris mentioned, the primary focus has been on integration and growth. That is absolutely critical to long-term sequential success, and that's what we're trying to set the company up for. It doesn't mean we won't have ups and downs along the way, as some of our businesses have project-oriented components which have cost structures to sustain them. When we look at the highlights over the last quarter, we see that the results are working. We're seeing significant contract wins and expansions of existing programs. We are, however, still facing headwinds related to COVID and supply chain, and we'll talk a little bit more about those. So it's critical that when we look at the contract wins and understand that just because we announce a contract doesn't mean it's going to have a material impact on the quarter in which it was won. In fact, in everything that we do, it's either recurring revenue where it will incrementally build over the period of the contract performance, or in the project space, they take some time to work through and some time to, once you begin, to start recognizing. So there could be a typical contract that's a year long is going to build in quarter increments once it starts to move. And right now we're seeing long tails from actual contract win and planning starting to being able to execute with all of the access restrictions and the supply chain challenges that are out there. So we'll talk a little bit more about that. Critically important to note, the reason that we know the strategy is working and the reason that we're very bullish on where we sit is that our backlog is growing. When we look at won contracts, both transactional and large in scale, we're seeing substantial wins. We're seeing growth in the backlog, and that's in part because we're winning more, and in part because of some of the delays we experienced in third quarter and expect to continue experiencing through fourth quarter. The supply chain delays are real. Everyone in our sector is experiencing them, and they work all the way down through the equipment manufacturers, through our reseller partners, and to us. So we are seeing those. We're very excited as we look forward. When we look out into 2022, we feel that we are well positioned for at least 30% growth. We reasonably believe that 30% is the floor, and that the growth could be 60% range at the top end. This is across all of the sectors of our business, and this is because a lot of our businesses, as we see them, as we see the contracts growing, we know that they will recognize revenue out over long periods of time. So lag is hard to account for and not something that people often like, because instant gratification sometimes feels better. But in our business, it's about stacking the revenue on top of contract after contract after contract and getting to that place where the arrow is pointing up, the revenue is predictable and stable, and allows us to make sure that we manage to profitability. As we look at, again, those headwinds, we see in first quarter some easing of the headwinds, and it's not because the supply chain issues will go away or because COVID is going away. We've been advised to expect long delays throughout 2022. Some manufacturers' supply chains are disrupted, and they believe it'll take till 23 for them to normalize. So the reason that we believe that we will see these easing and we see an accelerated pace is that a lot of companies are returning to the office or pushing forward regardless, and they've committed to move things in first quarter. And what material is currently in the supply chain is starting to make its way out to the end of that chain, which is to the ultimate destination that it's going. So while there have been shortages, we are doing that. We're also managing our supply chain much tighter than we ever have in the past. While we're not an equipment manufacturer or anything like that, we are looking very deeply into the places where we pull cable or pull other supplies from. We're looking far more deeply into those to get farther ahead of the project work and understand where there may be delays and plan accordingly. Additional headwinds, as we talked about, we did see a very significant spike in the inflation and gas prices, both of which have the potential to compress margins and did so, and we expect to see that pressure continue. The trend does not look like it's abating. That said, we've taken countermeasures to ensure that it doesn't impact our margins going forward. In Q3, it definitely spiked more quickly than in Q1 or Q2, and we're now prepared for it going forward and adjusting both our margin structures and looking into how we can manage those costs. As we look forward to 2022 and beyond, we are getting a better handle by consolidating all of the systems of the company, all of the processes, all of the people, all of the management structure. And as we get closer to 2022 and into 2022, we will be looking at giving more concrete guidance and trying to give our investor base as much insight as we can reasonably give without having wild fluctuations or changes. The business conditions out there are still somewhat challenging, but we're going to try to provide those. We look at our recurring revenue in every sector of the business is growing, and there is recurring revenue across the business. Our goal is to drive that to greater than 50%. And we have reasonable expectations that we can get there. That includes our Overwatch sector, that includes our newly announced Secure Voice Corporation, that includes our traditional ADEX business and our Highwire business, all of which have recurring revenue elements of them and a strong focus on growing those. As those grow and stabilize, we're really excited about what that can bring. A little bit about the cybersecurity space. If you're following that, it is exploding. For us, our new partner acquisition has been phenomenal. We are acquiring new partners every single week. We are acquiring new contracts every single week. There is a lag between bringing a partner on and then either transitioning their customer base over or positioning them to sell the portfolio. Once they get it and once they get customers moving, the momentum tends to accelerate. Our focus is still on driving all of our revenues through business partners in every sector of our business. We're a channel-driven company that allows us to keep a lean and mean organization on the sales side. Our partners are embracing the platform. and partners of the size and scale that we're used to working with across our core businesses, our core installation businesses are embracing it as well. So on a final note, we want to talk about interpreting some of the loss data. It's critical to note that the change in derivatives is not something that we can control. Those are non-cash charges, and the only way that's going to change is as some of the old debt instruments work their way through the system, or as we find ways to improve those structures. Chris and the finance team are working every day to improve our existing finance structures to both lower costs, change the way fees are calculated, move them to interest, which is more beneficial to the business and more reasonable, as well as improve cash flow. So management today is confident in our liquidity for the next 12 months. That was reflected in both the Q2 and the Q3 filings, and how the going clause concern was taken out of previous financials. So we're very excited about where we're going, and we focus on operating income and EBITDA, which are the two that we have the most control over and the best indication of the company's ability to make money. So we're excited about where we're going. Again, I can't reiterate enough. It will take a little bit of time. It's not a straight line up to the top. There will be plateaus, there will be peaks and valleys. There's a lot of things going on to navigate, but we are extremely excited about where we're headed. And we believe that we've got the right team on the field right now. And that as we continue each and every day, we want to make sure that every member of that team is in the best position they can be in to win. So thank you very much. And we look forward to next quarter.